private markets have become a huge part of the investment world, and it cannot be ignored. Often they have promised outsized returns, and sometimes they have delivered. Other times, not so much. But they cannot be ignored, and so now we are going to be looking at the short and medium-term strategies for approaching these markets. We're doing that with a heavy hitter panel that is going to be led by Stephanie Hoy. Stephanie is the head of private equity for Asia and the global co-head and co-chief investment officer for global growth equity with Goldman Sachs. She's going to be up here putting the hard questions to our panel, starting with Jeffrey Perlman, the CEO of Warburg Pincus. We have Jonathan Sokoloff, who is the managing partner with Leonard Green and Partners. And finally, John Zito is the CEO with Apollo Management. It is a heavy hitter panel. Stephanie, you're ready to go. Let's get them up here, please.
Very honored to be here today with a heavy hitter panel. So I just want to make sure that you know the lay of the land as to who and what they do with the AUMs first, and then the focus, and then we'll go to have a very interactive discussion. So maybe I'll go from the other side first. So John Zito, Apollo, synonymous with credit. The AUM, by the way, I have to keep looking at the AUM because it keeps changing. So last week it was 860 billion. Last night, congratulations on the results, closer to 900 billion, approaching a trillion very quickly. And mostly credit, so that's the stage for you, for John. And then John, just to confuse you, there's another John on the panel here.
Jonathan, so it'll be easier to know.
Okay, Jonathan, we're gonna go with Jonathan. So Jonathan is synonymous with the king of retail. All of you in the audience, if you had Shake Shack, that's him. If you have complaints, go to him. And $75 billion of AUM. Stay pure to the core. He is a US investor and retail being a part of it, but services increasingly very important to him. And we'll talk through what he's seeing in the trends there for the consumption. And then you have Jeff here. Jeff is more diversified, $100 billion of AUM. Started as a core PE investor, so we have roots similar, but since diversified into real estate as well as to capital solutions, i.e. credit. Also, he had his roots, he's back home here, he was in Asia for many years, and so we'll talk a little bit more about what he's seeing in Asia as a trend. So with that as the lay of the land, we'll start with something a little bit warmer, easier first. So you have been traveling the world, and if you could be sharing with us key themes and top of minds for investors and corporations, and we'll make it short before we go into each of you for your focus. So with that, Jeff, I'll start with you.
Well, great. Thanks, Eddie and HKMA for hosting this great event. It's always great to be back in Hong Kong. Look, certainly I've been doing a lot of travel around the world, and look, I'd make a couple observations. One, certainly coming out of Liberation Day, I think investors and allocators around the world have started to, I think, rethink a bit of their U.S. exposure. It's not to say that it's going to somehow go from a hyper-exceptional level down to an average level, but I think a lot of folks are looking at bringing hyper-exceptional down to exceptional. And so think about it as maybe a 5 to 7% change in allocations. And I do think when they look at, do they steer that capital to Europe? Do they steer that capital to Asia? I think they look out, they see Asia with 50 to upwards of 2/3 of global growth over the next decade. And I think, the marginal dollar may end up more coming to Asia. So I think that's certainly one key area. We've heard enough probably over the last 2 days on AI, so I'll leave that one aside. But certainly it's the main topic of conversation across a lot of the meetings we've been having.
Great, thank you. Jonathan.
Thank you, and Eddie and the whole gang, thank you for having us all again in your beautiful city. So I, like Jeff, have been traveling around a much, but just to set the table a little bit. So 40 years ago, I moved to Los Angeles to join Mike Milken and Drexel Burnham and the junk bond crowd, really the birth of the private equity industry. And we had a fireside chat at our conference in the spring, and the title was Just Another Crisis. And as we look back over 35 years at Leonard Green and 40 years in the business, there's probably 10 or so major crises we've been through, and probably a third of the time we've been investing, we've been in a crisis of some type. Pandemic, war, 9/11, GFC, you name it. So for all of us, you have to keep that in mind. And it's easy to get negative and down on all the problems and all the crises, politically, geopolitically, militarily. So on this world tour that I've been on the past couple months, I was kind of uplifted by a lot of unifying forces that I saw out there that give me hope and optimism for business and for the world. I started in Riyadh, and Riyadh was having their comedy festival of American comics coming to Riyadh. Unthinkable, unimaginable just a few years ago. Then I went to Abu Dhabi. It was a Jewish holiday. I went to a synagogue. I went to services in a synagogue built and paid for by the government of Abu Dhabi, and that weekend was the NBA weekend. And then I went to Tokyo, and I went to a baseball game in Tokyo where the Tokyo Giants are playing. And then I went to Seoul, and there's an American artist having a big exhibit. And I went to Mexico City, and I went to Toronto. And everywhere I went, I did find just hope and optimism, and also tremendous entrepreneurship. There's a young group of folks, many of you in this room, that you're starting new things, you're doing exciting things, and in the end, we're a growth investor, and we just have to find growth. And there's so many good things happening in the world, in economies, that I think will overpower, the negativism and the conflicts and the tariffs and whatever else it is. So that was just kind of coming out of 2 months of kind of circling the globe, and I'm feeling excited and just empowered by what I've seen.
That's great. And Jonathan, so globalization is not dead. So good to know that.
Yeah, people want to be together. They want to work together. They want to share each other's musicians, sports, entertainers, hamburgers. I mean, Shake Shack is amazing. I mean, we have 50 businesses. We go into a meeting. Probably our smallest investment in the past many years is Shake Shack. And people love to talk about Shake Shack. We made a fortune on it, but it's a little, did the world need another hamburger? But it's another unifying aspect. I mean, I was here when we opened it.
It's the ultimate unifier in my family. So
yeah, well, when we opened in the IFC, and we displaced the Pure Gym restaurant when we were an investor in Pure Gym here at the time, and it was a crazy thing.
Great. So John, we're going to do something slightly different. We're going to weave your views of the world to you being a defender of the credit industry, because we heard earlier today from Katie, who's a former colleague of mine, saying that there's nervousness in the credit market. We also heard from Nicholas just now from Perlman saying that his restructuring business is actually it's 5-year high. So you, being the defender of the credit world, what are you seeing, what are you hearing, how do you feel about the world?
Well, first off, it sounds like I want to go on business trips with Jonathan. I mean, my business trips are definitely not as fun as that. But I guess that's the difference of the growth business and the value business. But I'm definitely changing my 26 plans pretty quickly.
You have to have some fun on all these trips.
I hear you. I think credit, again, the excitement about credit, I'll start just every meeting that I have, people ask, okay, what is happening in the broad markets? Why are equities at all-time highs? Why is gold at all-time highs? Why is Bitcoin at all-time highs? Let's forget the last couple days. Why is every asset class, why are rates down? We don't understand. Why is it happening? And if I walked you through this backdrop, we're going to cut interest rates somewhere between 8 and 12 times. We're going to put probably the biggest deregulatory push into the financial system that we've seen in the last 15 years. We're going to allow for effectively all M&A to get approved. Companies that we've been looking at to actually get sold or do a transaction for the last 15 years that never would have been approved, all getting approved. And you add to that the single biggest platform shift in technology that's going to provide earnings. We can debate, and I see all the panels, everyone's debating who's going to be the winner and whether or not AI is real or not. The likely outcome is all of the, let's say, 3 to 4 trillion of CapEx is going to result in benefits to the consumer. And we'll see where the profit pool goes, but it will benefit somebody. It kind of makes sense that risk assets are up. It really is a market for this year, really a quantitative easing type market without quantitative easing, because it's all being done by different functions. And we had the little bit of tariff scare, but now that we've kind of moved past that and inflation seems to be somewhat in check, it's hard not to take risk in the market if you're a risk participant in any form. As for the defender of credit, I don't know if that's, we are a big credit participant. With the backdrop that the economy, broadly speaking, is doing fairly well, it's very hard to go into a recession when you have 40 trillion of book equity in U.S. homes. It's just functionally really difficult when you have that amount of asset value in the system that really has been untouched. The cohort of non-homeowner, non-asset owner, really the subprime, that's where you're seeing all the pressure. I expect you'll continue to see that pressure. We are concerned a bit about that cohort in the overall economy with all the pressures with fewer jobs, higher inflation potentially, and not experiencing any of the asset growth. That's a difficult position to be in, and it is something that is a bit more on our screens. But as for the headlines, I have not. We really aren't seeing it in any of our portfolios. The one sector that is was the single biggest sector for LBOs and private credit was software from 2018 to 2022. I can promise you there wasn't AI in any of the risk factors in the 2018 memo for a enterprise software business. And so I had the interns last summer. I had them go through every conference call from 1997 to 1999 to get the quotes of every company that said the internet would be good for their business. And then I had them go to 2004 and 2005 and look at all the companies that said the internet would be good for my business that didn't exist anymore. And you have to laugh because every single management meeting and every single sponsor meeting I have, AI is going to be great for my business. AI is not going to be great for everybody's business. You have to move super quickly. You have to have a very flat organization, and you have to believe and move at a pace that is really hard for large organizations. And I think there's going to be a lot more dispersion amongst many businesses because of the new platform shift that's going on in technology.
Thank you, John. Let's just stay with you a little bit longer. So I'm hearing from you that there may be issues, but isolated pockets of issues in credit, but I'm putting words in your mouth, but you're okay with the credit side so far. Can you share with us, this whole discussion about duration mismatch? By the way, I started to have my eyebrow moved because you actually have insurance capital, and there was a discussion earlier on about insurance capital having a mismatch with credit. Can you just comment on that?
The retirement business and insurance business, as many of you know, has been a very large driver of Apollo's growth, but also the broad industry's growth in terms of just assets under management. And there's been lots of comments about the amount of risk in both private credit and on the balance sheets. When you look at the overall percentage of assets that are actually in the insurance industry, it's a very small percentage of the aggregate assets. And in fact, when you talk about ALM mismatching, maturity transformation is something that regulators talk about a lot. That's the ability to move a liability, the speed at which you can move that liability. A deposit, for example, is daily. A 10-year, any sort of 10-year liability is obviously long duration and typically non-callable. So when you move an asset from daily to long duration, typically that's safer for the system. And we've tried to be very cognizant of that. We were a really fast grower in the market. A lot of the incumbents didn't love us. We are now a very large part of that ecosystem. And when you're a big, large part of the ecosystem, comes a lot of responsibility. And we take that responsibility really seriously. And if you look at everything we're doing on the balance sheet, we're trying to run the balance sheet at really AA levels. When you compare us to any other balance sheet, and I'm not going to speak to the industry, I'm just going to speak to what we're doing. 70% of our assets are rated by the big three. We're really trying to be as conservative and actually in risk reduction mode over the last 12 months. So it is somewhat comical to hear some of the comments.
Great. Okay, we're going to go to the elephant in the room for anybody who is invested in PE. And that elephant is called DPI. Okay, so why no DPI? Is it a prevalent issue for all PE investors, or are you experiencing life very differently? Jeff?
I saw Eddie smile. He likes DPI, I know, as do many of our investors. And look, what I would say is what's unique about the last 3 years in private equity, and I think both would agree that the industry really doesn't have a good excuse as to why they shouldn't be delivering DPI, because unlike the previous periods where you had a material drop-off in distributions, it was tied into poor public market performance, right? It was right after the dot-com bubble burst. You had kind of 2 years after kind of the 9/11 period. You had 2 years kind of with the global financial crisis. Here, we've had kind of record public market performance. So from our side, I think part of the issue, I think you can point to a couple factors. One was obviously investors did way too much in the 21 vintage. They did 200, 300% more than their historical average. And obviously, they're trying to take as much time as possible to kind of grow into those valuations. And look, we always talk about real marks are demonstrated by actually selling. And if you sell, then obviously you've proven out the mark. So I think the 21 vintage is a huge issue, number one. Number two is investors forgot about the core principle of diversification. They went to very concentrated portfolios, either by geography, by sector, by stage of investment. And our experience, and I think one of the reasons why we've been able to distribute more than we've invested in 9 of the past 10 years, I think it's even true for 12 of the past 13 years, and I think has been reported publicly. We've had a record year of exits this year, and about 150% more distributed than invested since 2020, is because of being diversified, right? The ability to sell things that are uncorrelated, whether, this year, 8 exits in the first half of the year. You sold an energy transition business, an industrials business, 2 tech businesses, a financial services business in India. All these things are not necessarily correlated, and I think that's a big driver. The last piece I'll make, and let others chime in, is I think we're also in the sweet spot for exits. I think investors started to become too single-threaded as the investments became too large to an IPO. And I think as we talked and we heard some of the panelists yesterday, IPO markets are a bit structurally broken in that regard. And so we think of ourselves as one of the preeminent scaled middle market investors. Our average total enterprise value at entry is a little under $1 billion. And at exit, for those exits I mentioned, it was a little under $3 billion. Every financial sponsor can buy those types of businesses. Strategics can easily buy $2-3 billion businesses. It's very tough for them to buy $15-20 billion businesses. And then you end up single-threaded to IPOs. And obviously, we know the challenges in right-sizing the leverage from those large companies. So then they end up in continuation funds, which is not a great long-term trend if that's going to be some group's entire kind of form of their exit.
Yeah. So it's very interesting because you diversify and you go mid-market, so you're able to scale while doing those two things. I think that's very interesting. So Jonathan, I'm coming to you on how are you exiting your positions?
Well, I think DPI is correctly the most important area in our industry. I was at an ILPA, a small conference ILPA had in April, and the 3 major topics were DPI, the accuracy or inaccuracy of quarterly marks for PE firms, and the meteoric rise of continuation funds. Now, those are all linked, and they all are linked to DPI and the health of your portfolio. So what does DPI mean? Well, first and foremost, it means we send you money. So you like that, and that's what you need for your pacing model to work and the private equity flywheel to fly. But it's really a validation and confirmation that a PE firm is doing their job. They're investing in a business, they're growing that company, and someone else wants to buy that company from them at a fair price, which is then at or above their mark. So if a company comes to you, a PE firm, and says, our companies are great and our marks are really conservative and DPI is a little bit low, but everyone's is, and just be patient, give us another couple, 3 years. That may be true, but it may not be true. It may be that they haven't done their job and their company has not hit plan and it's overmarked. So let's assume we go to sell a company and or a PE firm goes to sell their company and they have it marked at 100. And they have a process and the bids come in at 85 or 90. So what's the PE firm going to do? And if at $100 to sell it, that's a 5-year, 20% IRR. Well, they can sell it at 85 and take a write down, forget it. They can not sell it and reduce their mark to 85 to reflect the market. Never happens. Or they can just not transact and they can wait. Always happens. So if they have a good company and they sell it in a year at 100 and they wait, they keep their mark, the IRR goes to 17. In 2 years, 14. 3 years, 11. So in 3 years, the IRR falls in half. There's a lot of that going on because a lot of companies are mismarked. We still have tremendous discretion in where we mark our companies every quarter. Now, we know LPs don't want low marks. People don't want bad news. But there are a lot of mismarked companies. And as Jeff said, the only real validation that your marks are valid is when you sell. And have you sold at your marks or above your marks? So we all have these numbers we spew out. Our average sale is 20% above our marks. When I went to this ILPA conference, they said our industry is supposed to return 20% of NAV per year. That's how the industry stays healthy. And Bain Consulting yelled at us and said, we're not doing our job. We're only running at about half that amount at 10 or 11%. Bad. So we've returned, on average, 20% for the past 5 years. What not only means we're doing our job, that our marks and our posted returns are accurate. And our returns are, by the way, have not kept pace with the public stock markets. Nobody has, but we think they're accurate. And if you haven't had DPI, it may mean both your marks and your returns are not accurate.
So the only thing I would just add to the other scenario would be, instead of just holding, is one of the areas that I think a few of us play in is capital solutions, which is then folks trying to take that type of capital, which is obviously more expensive capital, to kick the can down the road and preserve the mark on the valuation. It's been a great place for us to put capital because on a relative risk return, it's great for the groups like ourselves who are providing that capital. But it is pushing and kicking the can down the road.
Well, and we talked about continuation vehicles, which was the third subject at ILPA, and basically it's a very imperfect, challenged model full of conflicts of interest, and we're thrilled we have it. We're thrilled we have it as a tool in our toolkit to help get exits in a challenged market. Generally, you're kind of selling some good stuff cheap. And we thought that was such an interesting development that we decided to raise a continuation fund to be on the buy side. So we have a fund now to invest in the CVs of middle market PE firms where we think they're selling their best companies cheap. We want to be on the buy side of that trade, not the sell side.
So very interesting. I think what Jonathan, you're basically insinuating you have no issues on DPI because you're marking your books correctly, and there's a real market for that at this moment. And there are a lot of regulators in the room, so that will pique interest.
We have plenty of issues.
Yes.
Nothing's perfect, but directionally, if you're doing your job, these are results you should be getting.
Okay, great. Sorry.
To that point, I mean, you should turn over your inventory every 4 to 5 years. That's the industry. That's what it's supposed to be, and I think not enough are doing it.
Great. So I'm going to go to John. John, in your career, in your day job, you basically pick also the right GPs who know what they're doing, and you back them with a credit on some of these purchases. So there are many GPs out there. These two are the top performers in the industry. So can you share with us the good GPs, like what are the trends you're seeing when you actually give them credit?
Yeah, I mean, these guys are being pretty modest. I mean, there's what Joe. What do you say? 19,000 PE firms out there. The by and large, we cover I think close to 700, but most of our financing happens to the top 75, and most of them happen with firms that you can trust and have been with for really long periods of time. And these two guys are being again pretty modest, but they've been doing it for a long time. And by and large, if you play games with the things that's being commented here. Over time, you'll lose trust with both your lenders and your investors, and I think over time it will be fixed, but it's probably taken longer than some of us would have liked. I do find it funny in the markets when a company can't go public, so then now they just sell to the CV market, which is just something I never thought I'd see in the market. And you have now not just single asset CVs, you have multi-asset CVs. And so what you're going to see in the industry is all this evolution, and it's happened in the credit business where, you know, when we started in the credit business, private credit was lending to, you know, 3 or 4 car washes in some small town, and we'd roll up the car washes and we make a $50 million, $75 million loan and grow the business and partner with the sponsor for several years. And now private credit is an $11 billion loan to Intel. So the world has definitely changed in the credit business, and the equity business is changing. And the equity business, the opportunities to exit will change. The evolution of new evergreen products for equity will change. And at the core, the people who actually can invest the money well will be able to sell it to lots of different buyers. There's going to be lots of different buyers that you didn't think would be traditional buyers of private assets. And that's the big thematic that's happening. It's happening a little bit slower in equity, but it's going to happen. And most of these assets over time, I think, will end up being much more liquid than historically was perceived.
We have a very good car wash chain. So
now it's like 200 car washes, so it's like different.
We'll make sure we show it to you.
Okay, I have a few topics to cover, and I only have 2.5 minutes, so I'm going to be aggressive here, and we'll do rapid fire, but like pretty deep topics here. Okay, Jeff, China, Asia, go.
Wow. No, look, Asia for us, we've been in Asia for 30 years. We'll just celebrate our 30th anniversary in India next year. As I said, we think it's one of the cheapest places to invest in the world right now. I think China, the challenge for the previous few years was that the valuations hadn't reset. Now that they've reset on a relative basis, it's getting quite attractive. I mean, you can buy businesses that are growing at 20% a year that you can all of a sudden buy for 5 or 6 times, EBITDA. The question is how long is it going to stay, like that? And so I think, so many of our peers have kind of pulled away both from China and from Asia. But I think as you look out, I think it's going to continue to be an interesting opportunity. And you take a market like India, the flywheel's working so well between the public market, both new issuance, the ability to sell down, the interest level from strategics, and obviously more private equity capital going in. So we just think that flywheel produces scaled investment opportunities. You can invest in more control now that you couldn't, 5, even 10 years ago. And again, you can come in and you can get out. And I think that's why I think India is going to continue to draw a lot of capital going forward.
Great, wonderful. Jonathan, company building, what is your secret sauce in 30 seconds?
Look, our job is to find a company that we have high conviction that we can double, triple, or quadruple over the course of our ownership. And we view ourselves as growth accelerators. Are there 2 or 3 fundamental changes we can maybe make to their business model to make them grow faster, whether it's organic growth, whether it's an M&A, whether it's tech-enabling old economy businesses. And look, the first rule of any investment committee member at Leonard Green is why we won't lose money. We come from Drexel. We saw all the junk bonds. We went bankrupt. It was pretty ugly. So that's our first rule. And the second is, can the business go backwards? What could happen to really mess up the business? And this is the skill we've developed over 35 years. And if we double, triple, quadruple EBITDA, no matter what crisis comes, no matter what the stock market is or interest rates are, we will make money. We may not make as much money if multiples come down or this and that, but we'll still make money. So you must have conviction and be able to grow these businesses.
Great. Wonderful. And John, you have the last word here. How do you manage $900 billion and still maintain quality?
The paradox of scale and artistry is one that's really hard, and I grew up in the small markets business running a small hedge fund, and now I oversee and I promised myself I would never be the, $900 billion provider of capital, and didn't think that that would ever become actually an outcome. So it's been a fun journey. The 60% of our balance sheet's investment grade. Our opportunistic business, our private equity business still has not actually grown in size. Our hybrid businesses, our opportunistic businesses in general, kind of up and down the capital structure, have still stayed somewhat inside. Most of the growth have happened in the BBB single A part of our business. And so that part of the business is all about origination and finding different asset classes that have super stable cash flows. And the alpha construct is a different construct. It's about earning an extra 100 basis points, 150 basis points, not earning 18% absolute rates of return. And when you think and you frame it that way, it's much more manageable, and it allows me to sleep at night and still perceive ourselves as great investors, which I think at our core we've always been and remain committed to that. So, we're pretty excited about continuing to grow, but mostly in the performing credit part of the business.
Well, thank you very much. A lot of wisdom, a lot of materials, and we look forward to the next panel. But thank you for your time.